Markets keep climbing, but so do the headlines. Trump's tariffs, soft jobs data, and split earnings have defined July. But what does it all mean for investors? Hello and welcome to the Market View for July. I'm Nathan Sweeney, CIO of Multi-Asset at Marlborough. Markets continue to climb the wall of worry, navigating a steady stream of news from Trump's sweeping new tariffs to the Federal Reserve's wait-and-see stance, and an apparent slowdown in the US jobs market. Let's break down what happened in July and what it means for investors. Trump's tariffs, a new trade regime. On August 1st, the US officially ushered in a new era of tariffs with updated rates on dozens of trading partners. Taiwan, 20%, Switzerland, 39%, Canada, 35%, India, 25%, EU and Japan, 15% as part of new trade deals. So this marks the highest average US tariff rate since 1934, jumping from 2% at the start of the year to over 18%. So this is like the world's biggest economy just added toll booths to every major trading route, some at heavy prices. While some countries secured deals, the UK, the EU and Japan, others like Canada and Taiwan were hit hard. So the goal here is to boost US industry, reduce deficits and fund tax cuts. But the risk is higher costs for businesses and consumers, especially if global supply chains absorb less of the impact over time. So our takeaway here is that higher tariffs may mean short-term inflation pressure, but the long-term market impact will depend on how consumers and companies respond. Next up, the Fed holds fire, but cuts now look likely. The Federal Reserve kept interest rates on hold in July, but for the first time since 1993, two members dissented, calling for immediate cuts. Why the hesitation? Fed Chair Powell cited uncertainty around the impact of tariffs on inflation. The view is that price pressure may rise temporarily, but they want to see more data before acting. However, markets have now priced in an 80% chance of a rate cut by September, up from just 38% before the latest jobs report. Our takeaway here is with growth slowing and tariffs adding pressure, the Fed may soon shift from patience to action. Now let's look at the labour market. We had some softening here in the labour market. And so is this sending a signal? So July's jobs hiring report showed just 73,000 new jobs, well below the 104,000 expected, with unemployment nudging up to 4.2% from 4.1%. So the analogy is the jobs market is like a car that's still moving, but clearly easing off the accelerator. And while wages are still rising faster than inflation, so 3.9% for wages versus 2.7% for inflation, slower hiring suggests growth is cooling, which could weigh on consumption in the months ahead. So our takeaway here is that the labour market is sending a message. The economy is cooling, not crashing, and that could push the Fed to cut rates sooner. Next up, we have corporate earnings, a market of two halves. It's been a strong quarter for markets overall. But under the surface, a clear earnings divide is emerging. Tech and financials are flying. Microsoft, 25% profit growth. Meta, think Facebook, Instagram, 36%. JP Morgan, Goldman Sachs, strong beats. But consumers and industrial names are struggling. Ford posted a surprise loss, citing an $800 million hit from tariffs. Companies like Whirlpool, think washing machines, and Delta Airlines reported slowing demand. And now the 10 largest S&P 500 companies account for a third of total profits, propping up weakness in the consumer names. So our takeaway here is that staying diversified across styles, sectors and regions remains critical. And now on to our final thoughts. Resilience, but risks remain. The S&P is up over 20% since April's low, and July closed with markets near record highs. That reflects optimism around AI, fiscal policy, and eventual Fed rate cuts. But we're also seeing higher input costs from tariffs, softer jobs creation, slower GDP growth. So our takeaway here is markets can rise even in uncertainty. But that's precisely why diversification matters. While markets have remained remarkably robust in recent weeks, it's worth remembering that summer is often a season of lower volatility until it isn't. With heightened risks around trade policy, interest rates, and earnings divergence, a pickup in market swings wouldn't be unusual as we move through August. The key is not to fear the noise, but to be prepared for it. With diversification, quality assets, and a long-term plan, we can weather the occasional bout of volatility. Thank you for watching, and see you next month for another Market View.